And we're going to turn now to get a little bit more perspective on the story we've been reporting all morning, that wild ride on Wall Street yesterday. The Dow dropped, as we said, almost 1,000 points, a record one-day plunge. It was chaos before it bounced back to just another bad day in the markets, for about almost 400 points down. And of course, we really want to get into now what that means for all of you at home, worried about your 401k and retirement accounts. So we're going to bring in our financial guru, Mellody Hobson, the president of Ariel Investments, for some advice. And you know, most people probably weren't at home watching CNBC yesterday, Mellody, when you had that crazy 7-minute drop. But how worried should people be about it?
Well, I actually think it was a really great thing that most people had no idea what was going on, even though there was this sense of panic on the trading floors. I think it helped that they didn't know, because the best thing you could possibly do is ignore the noise and stay focused on the long term, really to preserve your investments. It's the people who react to these short-term dips and actually sell into the weakness that really pay a huge price.
Let's take a look. We can't guess the long term now, but let's take a look at the medium term. What's been going on the last several months, and give people a sense of basically what's been happening to retirement accounts over the course of this year.
Well, the thing is that I'm actually, even though people might see that their retirement accounts are down a little bit, especially based upon what happened recently, and they probably won't open their statements until June, and who knows what will happen by then. But I do believe we'll continue on this course of recovery. So let's think about it. Back in 2007, where retirement values peaked, the average account was about $80,000 in a 401k plan. Then we had that huge market dip, huge, the worst since the Great Depression, and those account values fell 29% to about $57,000. But then they recovered in 2009, and by year end last year, we saw those accounts at $71,000. They've been trending upward, and I would expect them to continue to do so.
Because the economy is recovering.
All signs are that things are better, from jobs to actual economic growth to just actual consumer sentiment. People are feeling better, contrary to the fear we had before.
Well, and let's separate out the issues, though. There is the panic selling that happened yesterday. Whether it was a machine mistake or human error, we will find out in the coming hours. But it's against a backdrop of recovery here, but real jitters across Europe, this debt situation in Greece, and a fear that it could spread across Europe and eventually hurt us here at home.
This is the way I think about it. We went through a trauma in 2008, and the market is suffering from post-traumatic stress disorder. It's clear, but we're jittery, and the market is reacting to even the smallest news. And so with Greece, let's put it in perspective. That bailout is $140 billion, certainly big relative to the Greek economy. But to put it in context, the U.S. government gave AIG, one company, $182 billion. So that should help, you know, put things in a different perspective. Right.
I heard one comparison yesterday. The Greek economy is about the size of the state of Michigan's economy. So significant, but not overwhelming. Mellody Hobson, thanks very much. You can get a lot more of Mellody's tips on our website at abcnews.com.